an exit. And we've got a really good panel. So we're going to run through various different topics. We're going to look at how long you need to give yourself to prepare for an exit. We're going to look at how do I actually prepare for the exit. We're going to look at the different types of exit. And then we're going to make sure we've got 10 or 15 minutes at the end for everyone to be able to ask any questions. So please put them, any questions you do have, in the chat box, and we'll come to them at the end. Before we go any further, though, we're just going to do a quick round of intros. I will go last because I'm the least important person here on today's webinar. So let's start with Richard Millington.
Hi everyone, I'm a partner in Shoosmiths. I do a lot of work investment projects in fashion. My personal background was around 8 or 9 years with Nike, and then subsequently some time with Iconics brand group that owned brands like Material Girl, the Peanuts brand, Umbro, and Lee Cooper. I guess some of my most recent experience was we worked on a transaction last year to acquire Bench. We've got various other projects ongoing right now. Over to you, Matt.
Perfect. Oliver?
Hi, my name is Oliver Shaw. I'm currently the CEO of Calibrate, which is a private equity-backed pricing, optimization, and location intelligence software provider for retail. And my background is as a serial private equity CEO, both doing trade transactions for buy and builds in my responsibility, my businesses, and also in exiting businesses successfully for the private equity investors.
Alan?
I'm Alan Horridge. By trade, I'm an accountant, but in the late 1990s, I found myself with a company called Americana, who were the owners of Bench in the original days. And for my sins, I headed an MBO in the early 2000s and exited the business not long after that. I've been there. I've literally got the T-shirt.
And Mr. Morley?
I'm a senior investment manager and director of the Manchester office of Brewin Dolphin. You've not heard of us, that's okay. We're a £1 billion business now, and obviously I love it so much. I've been here for just over 20 years. As a wealth manager, my role day to day is that I work mainly with entrepreneurs who, as you'll know, have very little free time whatsoever, and I try to help them to understand their own financial position and to help them throughout the business life cycle all the way to exit and beyond. We'd often describe wealth planning or wealth advisory as being your personal CFO or FD, which means we look after, I guess the distinction for this panel is I look after the individual rather than the business, so that the individuals can get the very best outcome for them and their family.
Perfect. Thank you, Richard. I'm also a wealth manager at Brewin Dolphin in Manchester. And I very much like to work with big corporates as well. But more importantly, we have a very good panel today, which covers all different areas. We've got the legal perspective, we've got the personal perspective, and with Alan and Oliver, we've got real practitioners who've lived through this. So it's a really good opportunity to ask any questions that you do have. So let's get straight onto it then. And I think when we consider an exit, the very first thing that we sort of have to look at is how far before an exit do I need to be planning one? So when do I know is the right time for an exit, and how long am I actually going to need to prepare for one? Oliver, it's probably a good starting point.
Yeah, so certainly, you know, from perspective of the experiences I've had being founders, we always need to be providing some thought to your exit plan. And the longer that you have, and the more thought that you put into it, the likelihood is that you can create value. So I would say optimally, running a 3-year plan that's focused on a series of criteria that you would accept, both in terms of value of the business or performance of the business as an exit period. What that will do is land you at a space where you can start lining your business up, and all the preparations you'll hear, from Simon taking, from Richard from a legal point of view or a financial point of view, organising the business from that point of view, but also producing the right performance for your business to be able to get the best value for it. So that can really focus the mind. So I would say, how long's a piece of string, but 3 years is a good time frame to think about.
Perfect. Alan, have you got anything to add to that?
The question I'd ask is not when, but why are you looking to exit your business? And I think that the why will drive the when. But I agree absolutely with Oliver. You need to have a good, clean record, 3 years minimum. 3 years decent accounts, properly audited, showing growth. And the other phrase that people kept saying to me when I was involved in this at the sharp end is make sure that the investors coming in are aware that there's some, and the phrase that was always used is there's some bread on the water. So there needs to be some sort of seeds for them to feed on going forward. So yeah, that's my advice at the moment.
Perfect. And Richard Millington, from a legal perspective, how long do you need to give them the best advice and to get everything in order?
It depends on the clients. I mean, you can, in simple terms, in terms of how quickly these transactions can close, can be a matter of weeks, up to a month if you're under extreme duress. What we prefer to see is a more measured plan where it starts really with a detailed data room that's built out. So having all that key information about your employees, where your IP is your IP in the founder still? Do you need to move the IP so it's in the right place? Making sure the right tax advice is in place that underpins how you might be moving parts of your business around, so it becomes one simple, easy thing for someone to buy. It's even the transactions. I mean, we're working on one right now, which has come unstuck right in the middle of it, because there's a financial irregularity that's arisen because of how one of the businesses was being accounted for, which is had to stop the whole process. So it's the little bits that can really trip you up in the middle of it. So the more you plan and the more you understand where that revenue is coming from, and you've got clear contracts and agreements that sit behind that revenue, it makes the process that you run, where ideally you can then invite in 2, 3, 4, however many interested parties it is, to go through that data room to then produce really solid bids. And it ultimately then gives you really good leverage to get the best value deal, ultimately, right? Because you're not going to be undone by something small tripping you up, that's going to ultimately have someone trying to reduce the price, chipping the price at the last minute because they found something.
Do you think that you get people coming to you early enough then, or do you find that it tends to be rushed through at the end?
It's hard to be too general. I have ones where I'm working right now very, very early stages, because we tend to work. Our preferred role is as trusted advisors, so you're always in there talking to the founder. You're not necessarily charging for it, but you're spending time understanding that business. So you have a natural relationship then with the guys. You understand their business, so you can give them that counsel as they're going along. Say, you know what, you probably want to have a look at that, and then. That's the ideal thing. Often it comes in from advisors who've already run a data room. They could have already had it set up. So it really depends. The key thing for us is when we come to closing those deals, it's having that process in place, making sure the right information is shared, so that when you're negotiating the actual contract as well, as early as possible, the issues are flushed out, so that you can plan on how you're going to tackle each issue, plan on how you're going to tackle each point, plan on how you're going to make sure ultimately, as the owner, you get out of it what you want, financially or otherwise.
Perfect. That's very good. And Richard, from the founder or the management team's perspective, if you're looking after their personal finances, is there a preference for you? Does it help to be in earlier?
Yeah, I mean, from our point of view, it's the earlier the better. Thinking about it, isn't it? It means you can get your ducks in a row. You can start thinking about what life looks like on the other side for you. I think what I talk to most clients about is the magic number. So that's a really key piece of information that it's really helpful, really powerful actually to know how much you actually need from this sale to achieve what you want to achieve in life. And theoretically, I guess good financial planning is you only work for as long as you need to. And if you've passed that point, then really you're just doing it as a lifestyle business. You must have the passion for it if you've passed that point already. But how do you know if you've got to that point? I think you can only know once you price up what we call pricing up your future life. So thinking about what you might want to do on the other side, And that's not necessarily, just disappearing off to Bermuda if it's on the green list. It's thinking about, the key things that are going to be really important to you. It could be that you go again, or that you want to do some angel investing, or you want to do some philanthropic stuff, or you just simply want to never work again. And if that's the case, then knowing that magic number is probably the most powerful piece of information that you can have.
Well, I think we can pretty much sum up then from what we've just heard that preparation in all areas of the business and giving yourself time is obviously beneficial, whether that's from legal, personal, or actually running the business. So if I've now decided that I've hit my magic number and I'm preparing for my business, and I know, Alan, you touched on it, in part. What am I looking for within my business to make it more appealing? And you've obviously been through this, you and Oliver. What team do you put around yourselves to sort of make you more appealing, and so that you get the best possible result for you?
Yeah, the thing I found when we were doing our MBO is that you need to have a really compelling story. We had a really compelling story. We had a really fast growth, and we're very profitable. And obviously people sort of bought into that. The other thing that really helped us was publicity. In the old days, this is the early 2000s, before social media had really taken off. We had lots and lots of things in the trade press, in
I think we've just lost Alan a bit there. Sorry, Oliver, would you mind picking up on that question?
I'll try to. So I think that you as you understand, your business and the opportunities that sit within it. I think it's really important that you do two things. One is really make it clear and easy for investors to understand that. So to Alan's point, whether that's press or trade campaigns and stories that you've put out there, you being really clear on what those, that value or that uniqueness of your business is and how that's got future and longevity. And then there's also that, I think what Alan called the bread on the water, or the money that's left on the table, is showing a buyer how they're going to double the size of the business in 3 years, if you see what I mean. So you can tell that story of continued growth and the fact that momentum is going to roll through. I think you mentioned something, Matthew, about the team. I think what I would say around that is, it's critical that you as a management team understand what it is that you're going to do afterwards. If you're selling the business because you want to walk away, then that changes what you would do. If you're selling the business because you want more investment to grow faster and you're willing to do another 5 or 10 years in the business, then that's a different thing. And if that means that as a founder you want to exit the business, you need somebody running that business as a chief executive already. Because if you're still sat in the main chair, you're going to find it really difficult in a process to extricate yourself from it. You need your successor to be in place and actually be proven already. Because if it's a case of saying, I can give it to Bob, the new investors sat there saying, well, hang on, I bought you. That's actually what I invested in. So I want you here for a while. So you need to think about how you're gonna, if you like, evolve the business through the exit in order to know, how do I build the team and how do I emphasize what the business does. The final bit is you need to sort out your dirty washing. Richard talked a moment ago about finding something out in the middle of a process, which is a bit of a bump in the road. Some of those things are binary. If you've got a dispute with a customer that needs to be resolved, that could actually be a walk away thing. It couldn't just be we'll download the value, or so don't leave anything undealt with, or at least if there is something in there, get it out on the table so that everybody knows that it's there. Right? There's no point hiding anything because it will be found.
Perfect. Alan, just to come back to you, you mentioned about marketing the business and the fact that you had lots of publicity. Do you think social media has slightly changed the way that you would have sold your business in today's world?
Yeah, social media has its downsides as well, doesn't it? And one of the things that I'd recommend is that you have a look back at your previous postings on various things and see if there's anything that you wouldn't wish potential investors to see, also there's nothing wrong with being in newspapers and being in magazines if it's for the right reason, but you do need to go back on your social media just to make sure there's nothing there as Oliver says, you know, you don't want your dirty washing out in public. You need to sort that out. The other thing, if I could just add before I forget, because when you get to my age, you do forget things. It's important as well when you're going through this process not to take your eyes off the current business, because it's so easy to get involved in 12 hours a day in doing things to exit the business, whereas the business itself is suffering because you're not paying it the attention that you need to.
Perfect. It's probably a good opportunity to bring Mr. Millington in whilst we're talking about getting everything on the table and making sure we've got things, you know, all our ducks in a row. I suspect from a legal perspective, that's even more important.
Yeah, I just want to reiterate what Alan said there is that you can underestimate the amount of time this kind of process can take and the amount of focus and energy, not just from you, but from others in your management team, depending on what kind of point you're at, really. And it is crucial throughout all of it to really understand not just the process, but actually from our point of view, you know, the bits of paper and what those bits of paper are actually saying, I'm going to say, and to really understand the impact of them. So I always say to people, you know, you're going to end up with a whole bunch of documents that you're going to sign, and actually each of them are part of a story. And you've really got to understand how that's going to work out. I mean, the crucial, you know, one of the crucial negotiation points, and one that we find is negotiated very early, is liability caps in these sort of scenarios, right? So as a founder, if you're doing a full exit, then you'll typically look to have, you know, no more than sort of a 12-month, ideally less, period on which that you can potentially be on the hook for issues that have happened in your business. And there's various insurance products. So it's very much understanding if it is going for a full exit, you know, what is it? Is this really going to be a full exit? Are you going to be able to cleanly walk out of this business and forget about it? Is there something that you're kind of secretly aware of that maybe you're trying to hide, in which case definitely bring it out, talk to your lawyer about it, because again, it comes down to having a smooth process where you can get to your objectives as quickly as possible.
Perfect. And Mr. Morley, once you know that someone's come to you and you're looking after their personal finances and you know they're going to exit, does that change your approach?
To an extent it does. You know, to an extent it does. I think when you are working in a business, you are the business owner, generally you've got a huge amount of flexibility over what you earn and how you earn it. So you've got control over dividends, bonus, salary. Obviously, when you've done some form of deal, whether it's walk away on day one or whether you hang on, that situation might change. And, you know, one of the interesting elements of having Oliver on this panel that I was going to quiz him about if we get the chance is, you know, often when I'm sat with people who've taken funding in PE funding or VC funding, you know, they'll ask us and say, well, can I go to my PE masters and ask for a pay rise, or can I ask them to pay into my pension, or can I ask them to defer my bonus to next year? Can I, you know, all of these questions where you had control before you gave up control. You've got to think about it, you know, and when we talked before about how early you need to start thinking about this sort of stuff, you know, you get certain allowances every year. I won't go into it right now, but, you know, you get certain allowances every year that you can use as when you're earning money and as salary, for example. And once you've sold your business, those allowances have gone, you know. So you've got to get your head around that stuff. Definitely, Matt. Yeah.
Perfect. It's probably a good chance to go back to Oliver then. Oliver, obviously, if you're preparing your business for exit and you've got third-party interests, so you've got different investors, you know, does that change your approach? You know, how do you get everyone on board?
Yeah, I think that the first thing, and you know, we've talked about it a couple of times, but this clarity over what you're trying to achieve is really important, Matthew, because if you're sort of arriving as, you know, without an idea of what the shape of the business is afterwards, it's really difficult for you to identify what the right home for your business is. And critically, the right home for your business might not be the person that's going to write the biggest check, right? So just because somebody gives you the big valuation and tells you it's going to be wonderful, you know, in certain circumstances in private equity, you might be asked to roll some of that money back into the buyout fund. Anywhere beyond, you know, 50-60% of it might need to go back in. You know, you need to make sure that you understand what the needs of that is. equally, I think Richard was talking a moment ago about the kind of reps and warranties that might be set against you. You've also got to think about, elements like deferred consideration and how it is. So, a price is not a price. A price is a structure, is related to a structure, and you need to understand what that structure is and how comfortable you would be with it. And so that means in certain circumstances, you might be more comfortable with a trade deal, or you might be more comfortable with some other structure that would work through. Critically today, literally today in software, private equity is paying 2 to 3 times profit as the multiple than trade is paying, right? And so actually at the moment, the most attractive deals are going to be private equity, but they may not be personally the most attractive deals, if that makes sense. And to your point, Richard, you asked the question about, how flexible can you be? What I would say is, all of those considerations, again, talking about preparation, need to be done before the deal, right? So once you've done the deal, you are an employee and you are in the mix with everybody else, and your ability to be flexible is limited. So the time, what you've got to remember if you're staying in the business is you've got to do 2 things. You've got to negotiate the sale of the business. You've also got to negotiate your personal deal. And if you've got a combination of investors in your business, you might need your own advisors to help you do that. But don't be afraid to do that. So it's not just, there's people helping you with the sale of the business. There's also people helping you with structuring it right for you. And I would say that, going back to everything we've said, clarity at the start of what your personal objectives are and what you want to do, and whether you're in for another 5 or 10 years, whether you're looking for funding to build the next piece of growth, or whether you want to come out, is really critical in understanding how that's going to work.
Yeah. Mr. Millington, if you
could I chip in there, please?
Of course you can, Alan.
Just a couple of things. Sorry, I missed a little bit of what Oliver was saying, but I think it's everybody who if there's anybody who is investing in your company, you need to do your due diligence on them to find out as much as you can about them as to how they, look upon your business and what their track record is. And if you're looking at things like salaries and bonuses and all that sort of stuff, it's a 2-sided agreement. They're asking you for things. You can ask them for things as well, and make it part of the overall agreement that your salary, your bonus, etc., is in writing beforehand.
Yeah, no. I think that's very important. Actually, I think what I was going to ask Richard then was, if you've got those multiple parties, Richard, do you tend to find that most businesses now have agreements in place early doors so that there is no conflict when it comes to exits? Or do you still find when you are an advisor on one side of the table to one part of the sale party that, there can be conflict?
Do you mean between shareholders, Matt?
Yes, sorry, yeah.
So generally, if we're buying, let's say, then if there is conflict, you obviously keep it within, right? Because you want to make it as simple and as smooth a process. So you'll often be told, no, it's fine, that shareholder will come along. You might have what's called drag rights, i.e., one shareholder might have the ability anyway, because the majority to pull others into the sale, whether they like it or not. That's not uncommon, particularly where you've got minorities. And so the extent to which, and if there's a good price being offered, then that soothes everybody. The extent to which they might have had an issue before with each other is swept away, because they're actually cashing out now. I think if you're on the sell side, then it depends what rights the shareholders have got. So as I said, if there's drag rights, if there's tag rights, the ability for the shareholders to jump into the sale, that changes the dynamic. If you need to have that shareholder's consent, then it does change the dynamic, i.e. the shareholders will have to agree to the sale. Otherwise, some shareholders may get left behind or may ultimately block the sale because the buyer might want 100%, right? Might want it fully clean. And then it comes back down to where their shareholders have come from. Sometimes there could be a key employee who's a shareholder, which you've got to think even more about. Okay, what's this person going to want to do after? Because potentially they're a key asset to the business. And so again, you get looking through the shareholders agreement, but but when you're doing that, it's not too late, but you need to have those shareholders move together. I mean, one thing to be super conscious of is always, you might have got on really well with someone before, and you might have decided, hey, it's okay, we don't need to have a shareholders agreement because we just see eye to eye, and that's fine. That does change 100% when money is on the table. All right. And suddenly they'll go and see their advisors, and their advisors will say, oh, did you agree? Oh, you didn't agree? Oh, there's nothing in writing. Oh, okay, maybe we've got more leverage here so we can push our position. So it's just getting that lined up might be a little bit painful at the start, because you have to have those uncomfortable conversations with other shareholders, with your partners, but it does help when you get to this stage. When, as I said, if you're the buyer, you want to buy something very clean, you want to have knowledge and understanding of the issues that could come, because the buyer will be spending money on professional advisors, on accountants, on lawyers, potentially on funders. So yeah, it's one that you have to be very mindful of.
And I think in support of that, Richard, not in a nefarious way, but a buyer of a business, particularly of a scale transaction, is looking for those breaks in the team. Right. And if they can find a way into the gap, even if it's just to get the inside track from an expert who just happens to be a disgruntled employee or a disgruntled shareholder, there's whole firms whose job it is to find those people. Right. So, getting everything cleared up beforehand and making sure everybody's lined up is just part of this sort of housework we were talking about before.
Yeah, I think one thing on that as well to be mindful of is if you do put yourself up for sale, it could be the competitors want to come and have a look at you as well. So you've got to think really carefully about how you manage access to, and thinking hard about what your USP is. And to the extent someone might try and undermine that, what is the barrier to another company coming in and setting up and just straight up competing with you, taking some of your best talent, et cetera, et cetera. You do have to be watchful of that.
Alan, just to come back to something you said about your agreements with other investors, how much focus in those early stages when you're seeking investment goes on exit strategies?
Probably not a lot in the early stages, but as it gets closer to signing the deal, you do start to think about exit strategies and how you're protected. And how you make sure that you end up getting what you expected to get. And we relied very heavily then, because it starts to get really sort of legalistic. We relied heavily on our lawyers to put together the right formal words to make sure that we were protected.
Perfect. Oliver, you've sat on both sides of one of these agreements again. As an investor, how easy is it for a founder to come to you to seek an exit? And equally, having founded a business and sold it, do you always feel comfortable being able to approach everyone? Or as Alan, was hinting at, then you've hopefully had these conversations far, early enough in the day to make these things easier.
Yeah, so I think dealing with typically, I think you can. I mean, in today's market, if you've got a decent business, people will be looking for you anyway, right? So you don't have to necessarily be picking up the phone to say, do you want to buy? Now, what you might do is particularly focus on some strategic buyers, some people you really want to have a relationship with. So you might have a target investor or investment house. You might have a trade business that you think would work well as a good home for your business, and it's not a bad strategy to develop those. Equally, from an investor's point of view, when you're looking for businesses to buy, some of the best deals I did were deals that we've been working on for 3 years. And to Richard's point before, he talked about the magic number. I remember one particular deal, which is a really nice piece of software, and I met those guys and said, we definitely need this. We definitely want to bring this in. And they had a number in their head, which happened to be sort of 15, 16 million pounds to exit. And their business didn't justify it. And we used to meet, every 2 or 3 months. We built up a really strong relationship until sort of 3-4 years later, they could justify a price that was close to their exit rate. And the business justified us paying the price. So we were able to do it. So I think, you're exactly the right thing is to maintain a good level of good quality relationships with some people that you might want as investors, or equally, if you're getting entertained, or if you're getting inbound, entertain those conversations. Don't be afraid to have them.
Perfect. Thank you, Oliver. I'm conscious you have to go now, so thank you for
your
your time.
Much, guys.
Thank you.
I'll catch you later. Cheers.
Perfect. I think what we're going to do now is we're going to look at the different types of exit, if that's okay. We often hear of the golden standard of an IPO, but I think we'll leave that one for the moment, and we'll probably look at trade sales, to begin with. Mr. Millington, would you mind just talking through what we mean by a trade sale and sort of the legal structure of one?
I guess in versus an MBO or an IPO, or
so it's
private equity. So effectively selling to a corporate, selling into another business, and you're selling as a going concern. And that's going to be structured either as a share sale or potentially as an asset sale, i.e. what gets transferred is your contracts, your staff, your IP, et cetera. Generally happens if there's a certain sort of tax or financial issue. More frequently, you'd expect a share sale in the kind of scenarios I guess we are looking at here today. And so in that eventuality, you become a subsidiary of the parent, your new parent, i.e. the corporate that has acquired you. And you typically find is those buyers are looking to acquire you as part of a broader strategy which they're looking to implement. So you fit neatly into that. And I think it's what Oliver was just talking about is how you find those buyers and how you can almost sometimes build your whole business so that it naturally will then plug into that other business. That's certainly something I've experienced when I was with Iconics Brand Group. We acquired a fashion brand there that we'd been talking to for 2 or 3 years, and the model that brand was actually operating to was our model, and they built that model deliberately so that when they got to the right scale, it was a very easy business to plug into our broader corporate business, which meant the transaction was really very, very smooth.
And would you say trade sales are the most common type of exit, or?
It's
a very broad question.
I wouldn't go that far in terms of this. That's on we all deal with sort of small parts of our world, right? What I generally deal with when I'm working, in fashion is it's a mixture, really. It's a mixture. At the moment, we're looking at one where they need to get investment in to make a bigger acquisition. So actually, that's going to end up being a debt that they take on to finance that acquisition, but there's going to be an element of equity that's built into that over time, and that's very much a creature of that particular transaction. We've got others that we know that they're building up, so they might actually be able to sell to a fund, because what that business is going to do is produce a steady stream of income over a period of time, and so it will naturally be of interest to that kind of business. The smaller one, the startups, the SMEs can be, more interested to trade, but often that first level of investment that comes in can be, you go through Series 1, Series 2, Series 3, etc. And that Series 1 funding can be 150, 200 grand, let's say, that kind of small level, which is just a whole bunch of different, can be friends, etc., before you then maybe potentially as your second round get more into private equity, which obviously we can talk about shortly. And then it can be private equity then are looking to actually sell it into some of the bigger corporates who've got, because it's not cheap, right? Who are then maybe looking to sell it in at that point. So
perfect. And Alan, you've obviously participated in a successful MBO. So would you mind just letting us know sort of what happened and what to expect of someone who's going through that process?
Well, it happened because we had directors and founders of the business who wanted to separate, and we did look at all sorts of ways to do it. We looked at a potential trade sale, we looked at IPOs, and eventually we decided that we put together an MBO. I was speaking to one of the directors one day, and he said to me, "You want to buy the business, don't you?" And I said, "Yeah, okay." And he said, well, name your price. So I thought, well, I know how this works. I say something ridiculously low. He says something ridiculously high. We meet in the middle. So I said something ridiculously low, and he said, yeah, okay, organize it in the next 3 months. So I rung up our solicitors and our accountants straight away and said, help, what do we do? And we started the process then. But the business had done very well in the previous three years. We had lots of publicity. We've won lots of prizes for the sales growth and all that sort of stuff. In 4 years, we went from 4 million turnover to 40 million turnover. So it's a real rapid growth. And the process was, from there, I was just swept along in having to do what I was asked to do. Had I known then how difficult it was going to be, then I might have we'd have still done it. But it does take up a lot of your time. The only advice I was given before we actually did it, somebody said to me, "Oh, I've done something like this. Go to your filing cabinet, photocopy everything, put it into files, index it, cross-index it, because no matter what it is, they will ask for it at some stage." And that was probably roundabout right. You have to provide an enormous amount of information and data to these people to get the thing finally sorted out. When we had our final sign-off session, it was about 2 or 3 o'clock in the morning in a big solicitor's office in Manchester, and there was me and 3 other of the MBO team sat around this table. And at one stage, I said to my crew, just count up around the table. And there was 28 people from the solicitors and the accountants around the table, and those 4 people, and mounds of paperwork. So it's quite a long, detailed, involved process. But hey, at the end of the day, if you get a big lump of money put into your bank account, it's worth it.
I truly hope so. We touched on this before, Mr. Morley. We have this idea of IPOs as being a gold standard. I suppose the question is it? And would you mind just talking through what an IPO is?
Sure. Well, an IPO is an initial public offering, and it can take many forms. And we've only 20 few minutes left, so it's probably not best to go into a monologue on that. But effectively, it's about taking a business that is privately owned by 1 or more shareholders to become a publicly owned business. And what that means effectively is issuing shares that the public can buy. And often it can be quite an expensive way to sell your business in terms of all the advice that you need throughout that process. And as we were chatting before this started, it's not always the golden goose that it seems to be. It's fraught with problems. You're opening your books up to the world, for another point. But it is an option. Lots of advisors who you might engage with along the journey. So we talked about building a team around the people selling that business and getting the right advisors involved. It's worth understanding that not every advisor can take your business public. Some do not have that remit and don't have the capability to do that. But obviously they're the ones that hit the headlines. And you asked before about trade sales and how popular, or if they're the most common exit and in the round. And well, it's the IPOs and the trade sales that tend to get the column inches. Such and such is bought out by such and such. But actually, a lot of the deals that are happening, particularly in the Northwest, is happening through private equity. Generally, I would say, but you just don't really get to see as much of that because it's done privately. And I think that is the point about an IPO, is that you need to understand that all of your dirty laundry goes public effectively, and you may end up losing quite a bit of control of that business. So
we've gone through those 3 now. The one that you touched on at the start, Mr. Millington, was private equity, and Richard just hinted at it then. I think in the press we're beginning to see it come to light a little more at the moment. Number one, is that fair to say? And And when we talk of private equity, would you mind just sort of explaining what we mean by it, and when we say a private equity sale, what that is?
Yeah, sure. And just before, just go back to the IPO point as well. It's just important to remember ultimately that's often a big fundraise. So, i.e., it may be that you're going to expand into new markets. You've got something that's highly scalable, but you don't have the full funds to enable you to do it. You have something that, institutional investors are ultimately potentially going to be interested in, and your advisors will be able to talk to you about how that can work. And you're exactly right. You do give up control. You're still going to have a stake in it, but you'll typically be giving up control and walking into a far more regulated environment, because ultimately, Joe Public can acquire a piece of your business. Hence, it is far more regulated than otherwise. And it's also important to remember that what can go public can go private. So just be super aware of the takeover code. Look at Man United as a great example. If you're publicly traded, you can still be privatized. People can still buy you. In terms of private equity, what is it? Effectively, it's a fund, i.e., somebody or a body with deep pockets, typically coming in to acquire you because they think they can make some money being part of your journey and exiting you in a, whether it's 3 or 5 or 10-year period, typically no more than 10. And they will go in and effectively provide funding for that period. You will get, pretty tight management, depending on the private equity investor. The kind of quarterly meetings with those investors, and they will get right into the detail. They will ultimately have bought into a plan under which they will exit. So they'll bought in at a certain multiple of EBITDA or revenue, and they'll have a target in terms of what they want to exit for, because their fund will ultimately be open for a set period only. And what that means is ultimately they've got that fund there to generate returns for the investors who put the money in. So they will be very, very focused on getting a return on that investment in a way that you probably weren't as a founder. And that can cause a lot of friction.
Yeah, they do come with sometimes a health warning. As a founder,
I would say it's not so much health warning. I mean, I do a lot of this not just in fashion, but in sport as well. And there can be a benefit that, strictly speaking, from an efficiency benefit, from a business efficiency point of view, they will bring a lot. That just isn't necessarily what you as a founder might have thought you wanted. To be blunt, but it probably is what is. You could argue about this, and no one size fits all, but it's going to drive the revenue, drive the profitability of that business.
Alan, I could see you nodding along.
Yes. First of all, I think with an IPO as well, that there's also a little health warning that you never know who the investors are going to be. And there may well be somebody who's building up equity in your business who you might not necessarily, if you knew about it, you would want it. And yeah, I agree with private equity that the amount of regulation that you have is completely different than you would have anticipated before. We got through the business by having virtually no management information apart from sales figures. And we had sales figures which we produced every day, and we showed previous day, the week to date, month to date, year to date compared to last year. And we stuck it up over the photocopier because we knew that everybody would always see those figures at least once a week. And that's probably about all that we really used, to drive the business. When we got to private equity, we had to produce something like a 30-odd page management report once a month, which we looked at in the third week of the month, by which time things had moved on. So yeah, the regulation does change with private equity, and sometimes in a dynamic business it can get on your nerves. And I think I said beforehand when we were chatting, go and ask Mike Ashley.
Yeah, we'll leave the rest of that conversation we had before.
I was just going to say, Matt, I think we kind of touched on it, and Alan went into some detail on it around the MBO side of things, and it touches on all those points that we've just mentioned about who you want in your business and who you want owning that business. I mean, just because you receive a lump sum in your bank account, doesn't mean that you don't then care about the business that you've sold. Largely, there is a legacy, that you probably want to protect, and that's not always the case, by the way. Sometimes you're happy to have got rid, but I think in lots of cases, particularly the people that we speak to, they want to leave a legacy. They want to know it's in good hands and in good shape. And I think when you're selling the business to people who are already in that business, we touched on MBO, management buyout, but you can also sell it to a trust, for example, that's owned by the employees, and there's some fantastic tax advantages of doing that. But I think the important thing is within the MBO structure and within that trust structure is exactly who runs that business. You know exactly who's going to take it over. You've worked with them probably for 10 years plus. You brought them onto the management team. You know that they're in good shape, and leaving that legacy, I think, for some people more often now than ever before. I think particularly with a lot of businesses that have got a focus on ESG, and sustainability. It's a real it's a real positive in knowing exactly who's looking after that business for the next 20 years and beyond.
Perfect. So thanks for that. I suppose before we wrap up sort of different types of exits, are there any? I suppose we've kind of touched on it with all of them. Does it make a difference if we're looking for a partial sale? Is there any particular vehicle that's better for a partial sale? Again, it comes back to, I think, what Richard was just hinting at was, how much control do you want to lose? Sorry, Richard.
Yeah, so Matt, so if you're looking for that kind of, that partial exit, ultimately, with private equity, often you stay involved anyway, or same with an IPO. Often what you're looking for is that additional investment because you've got a vision and you need funding for that. So to the points that we've discussed around the private equity, the extent to which they'll come in with their own ideas. If we take private equity out, if I look at just a group of investors who are now going to be partners on a company, and we talked about that a little bit earlier, right, in terms of the importance of agreeing, it could be daft stuff like who gets to write a check. Not that anyone writes checks anymore, but you know what I mean? Who gets to authorize payments? Who gets to sign contracts? Who gets to decide who's employed? Who gets to decide if you're going to stay in that office, if you're going to open a store, if you're going to revamp your website, all of those little things. You need to think about. What we'll typically see when people are going in could be level of budget control, but it's with the likes of private equity, we said there's going to be all sorts of additional controls. And again, it comes down to, I'm saying this, but it comes down to the amount of leverage you've got. How hot is your business? How many people are falling over themselves to invest in you or to acquire you? And how are you able to heat that process up? Because if you are, you will be able to get away with less controls. You'll be able to be more demanding. And just like when you sell the product, if it's a hot product, you can get a better price for it, et cetera, et cetera. It's the same logic really applies there. So if you've only got one interested party and you need the funding, guess what? You're probably going to have to sign up to a bunch of controls you might not want to because you don't have any leverage.
Perfect. Thanks for that, Richard. Richard Morley, I'm a founder and I've just been through my exit and I've got this lump sum of money. Obviously I'm in a brave new world where I'm outside of the business, but am I at the number that I agree on the dotted line? Can you give me an idea of sort of the taxation around the numbers that I'm receiving?
Yes, I can. I'm not a tax expert, I'll caveat. But yeah, I mean, the term entrepreneur's relief is something that's probably, most people on this call will be familiar with. It's now actually called business asset disposal relief. But effectively, it's something that gives you a preferential tax rate on the first £1 million of your sale. And again, just to go back to what we were saying right at the start, if you can work on the basis that you're going to be exiting a few years in advance, you can do all sorts of things to try to reduce the taxation ultimately that you're hit with at D-Day or contract day, or whatever you want to call it. But I think the key, when you look on the other side of the deal, I think the key thing to think about is is what are you going to do? So have a plan in advance is really helpful if you can. But if you don't have a plan, it might be worth just taking some time after you get the money in your bank account. Just take some time before you do anything. And I think flexibility is something that I speak to most clients about. It's all very well trying to be super clever and avoid tax at every opportunity, but actually a lot of the ways in which you can avoid tax means that you're committing capital for a period of time, or you're locking capital away and it's hard to get back. I think flexibility, particularly if you're young or younger and you've sold out and you may well go again, or you may well invest in another business. As Alan was saying, invested in another business straight away. Keeping the flexibility with that money is probably something that I speak to most clients about on day one. And that's, there's always an offset, a trade-off between saving tax and flexibility, and having that conversation with the individual gets to the bottom of what's most important to them.
Perfect. It's probably a good thing. Alan, just leading on from what Richard was just saying, you've obviously been through the process, and again, just as Richard just described, you went straight back into another business. How did you feel when you first exited, and sort of what goes through your mind of what am I doing next?
It's a bit disconcerting to have a chunk of money suddenly put into your bank account. The sort of lottery winner effect. Whoa, great! And then what am I going to do with this? I can't spend all of this money. What am I going to do? And the thing that I enjoy in life is doing things and keeping busy all the time. So I quite clearly had in mind that as soon as the money was available, I would do something else. And I knew that the process was underway. And I got a phone call from my lawyer, and I was already in a meeting with somebody who I was just about to invest in, and did it straight away. So there's a continuity in keeping busy. The alternatives is trying to find something when you got this money in the bank and thinking, what am I going to do? So really plan what you intend to do with the rest of your life. And if you enjoy sitting on the beach in Bermuda, for 12 months of the year, fine and dandy. But if you're an entrepreneur who's built a business, that's probably not going to suit you for the rest of your life. Find something useful and fulfilling to do. And just one quick thing as well on tax avoidance. I always, thought that people who avoided tax were horrible and shouldn't do it. And that. But do take professional advice. When I sold out, part of my shareholding was gifted to my wife, and so therefore she had allowances that and we ended up paying less tax, and the advice for that cost us 1/10 of what we saved in tax. So do look at tax avoidance is legal. Tax evasion isn't, so do look at tax avoidance, and your professional advisor should be able to point you in the right direction, shouldn't you, chaps?
Correct. I think it goes back to what we said right at the start, and probably the key message from me on this would be to build the right team around you. Get the right advice at every stage, whether that's on the business or whether that's for you personally. It makes a big difference. And part and parcel of what we do is we always bring in a tax advisor to give you that advice. As Alan says, it's a fraction of the cost of the saving. I guess one other point to mention quickly on tax before we turn this into a tax seminar is just that, as soon as you sell your business, when you've got your money in your business, it's inheritance tax friendly. As soon as you sell a proportion or all of that business and the money's in your bank account, that's in your estate. You've got technically, if you were to pass away, you'd lose 40% of that. I mean, less the odd allowance here and there, but it's a big consideration, and it should be. I don't think it should be weighing on your mind on day one, but it's certainly something. If you have that advice in place previously, you can have a good think about how that affects you and your family before you actually receive those proceeds.
Perfect. Just a reminder to everybody that we're going to be moving into a different room. If you look in the chat function, you can see there's going to be like a post-networking discussion where rather than do a Q&A on here, we'll just open it up into a general Zoom room, I think. So from 3 o'clock, keep an eye on that chat button and follow the link through. Just before we do, though, Mr. Millington, you've obviously been involved in lots of exits and sales. So you've obviously seen lots of founders and managers go various different ways. Can you give us an idea, sort of a flavour of what they've done post sale, what the options are available to keep people? Yeah,
most of the guys I know who've been through it as a process, and actually it can also apply to senior execs, in a lot of the US corporations that I've been in, who've been party to options or LTIP schemes, who again have kind of into money, and to Alan's point, they've all stayed in some way, shape, or form. Whether they take a period as a consultant where you get involved in a bunch of other businesses, maybe look at non-exec work, but at some point they always do want to get back involved in something, and it can be a whole range of stuff. I mean, I know there was a sportswear exec that I knew that went into CBD stuff afterwards, ended up building out farms of that over in the US. So there's all sorts of different ways of doing it, but Alan's exactly right. It will be a change, and it'll be figuring out what it is you want to do with it, and looking at those different things, different ways to spend your life. But it's, from my experience, it has been they've wanted, it was like what you call portfolio career, right? I.e., some investments in businesses that they have an interest in, some consulting, maybe some not-for-profit work as well. So it's that kind of career that you kind of move into typically.
Perfect. And Richard, you obviously see, the people once they've exited. Sorry, Mr. Morley. That's my question. Once they've exited, you obviously see them do different things as well. But from a financial point of view, does the finances make a difference? Alan was saying some people might like to go on the Bermuda. You were talking about your magic number. Is there does it differ per person, I suppose, is the question?
Yes, it does. I think what we'll try to do is we'll create what we call a never work again fund, or a aptly titled NWAF. So that is a pot of money that will give you sufficient return and income to do whatever you want for the rest of your days and never have to work again. Assuming, of course, you've thought about the magic number and you've achieved that from your deals, and that's typically how we would structure it. Alongside that, you would then have a pot for lifestyle assets. So you might go crazy. You might want to buy a Lamborghini, or you might want to buy some property, or you might want to gift money to your mum, or whatever it might be. Generally there's a pot set aside for the fun things that you might want to do on day one, or at least within the first 12 months or so. Equally, you might have philanthropic aims. So you might want to look at, again, those that are able to exit with a large sum of money that's far more than they need. They may want to do something with charity or make charitable gifts. So we have to consider that. And then equally, as we talked about before, I think Richard mentioned it, as a portfolio investor, what we tend to do is we'll carve out a pot for private investments, so angel investing, and we would attribute zero return to that. Now, obviously, that's not always the case, and in lots of cases, those people who exit their business know a huge amount about their sector and their industry. They know how it ticks. They know who the good companies are. They know their mates who need some investment to grow. So, it's creating capital or freeing up capital so that they can make those investments as and when they want to. So, as I was saying before, it's about creating something that will give them security, whereby if you've sold something that's your baby, you've built it from scratch, maybe you've brought it through you've nurtured it all the way through, you've built this, you may or may not ever be able to do that again. So it's creating the security on those proceeds, and then alongside that, making sure there's enough money there for fun, and just planning it out and making, having a conversation about what they want to do. That's probably the starting point.
That's very kind of you. And I think there's 1 minute left before we head into the networking room. So I'd just like to take this as an opportunity to thank Richard ×2 and Alan And Oliver, in his absence, please do come into the networking. The Fashion Network have sorted this out so we can all speak to each other more freely rather than just through a chat function. And you really do have, the best in the industry available at your disposal here. So if you've got a burning question, ask it. And equally, if this is something that actually is affecting you now, ask Alan for a bit of business advice if you need to. Ask Richard, he deals with the biggest companies and the biggest transactions that go on in the north and the country, actually. That's probably a bit unfair. He's just based in the north. And the same for Richard Morley. So take it as an opportunity to get that, those contacts. But also, it doesn't end here, I suppose, is the sort of last point is, if those conversations are going on either between you and your family, your founders, we've spent a lot of time today talking about the benefit of getting that team in place. So the sooner you do that is the better. But it's 3 o'clock now, so I think it's time to click on the chat link to the networking room if you can. Thank you.